What's up everybody, Nate here, and yet another bank in the United States has shut down. Citizens Bank in Iowa had to be taken over by federal regulators just a few days ago after it took on some huge losses connected to loans. This is the first banking failure in Iowa since 2011, but this is not the first banking failure that we've seen in 2023. So far this year, we've seen some of the largest banking collapses in United States history from Silicon Valley Bank and Signature Bank, but a slew of other banks have also failed this year. And now this is leaving a lot of investors and Americans to wonder which bank is going to be next and how that is going to affect our economy. And that is exactly what we're going to be talking about today. So to just give you a brief recap, earlier this year, we had two of the largest banking collapses in United States history worth over $100 billion. Silicon Valley Bank's collapse was the second largest in United States history, right behind Washington Mutual's all the way back during the first banking collapse during the 2008 Great Recession. Now, Silicon Valley Bank's collapse was around $175 billion in total losses, which is much less than Washington Mutual's $260 billion back in 2008. Still though, with it being one of the largest banking collapses in United States history, that sent ripples throughout the banking world and the investing world, as many investors were worried if their assets that were tied up in Silicon Valley Bank and a lot of the startups that had money at Silicon Valley Bank were in danger, and it turns out they were. Billions upon billions of dollars ended up floating out of Silicon Valley Bank, and then Signature Bank, who was connected to a ton of crypto startups and crypto assets, also suffered the same fate. Their losses were a lot less than Silicon Valley Bank and Washington Mutual's, but they still equaled tens of billions of dollars. So that created a big stir throughout the entire financial system in the United States, and the federal government actually had to step in to backstop a lot of these banks that were ending up failing. They ended up tapping into the FDIC system, which essentially put a huge burden on a lot of the banks that were being successful in the United States, like Chase Bank, Bank of America, and so on. So all of these major banks that were part of the FDIC system, the Federal Deposit Insurance Corporation, they were assessed a one-time fee that would essentially cover all of the losses on all of these banks and make sure that people who had their money at Silicon Valley Bank and Signature Bank got their money back. So why exactly did these banks collapse in the first place? Well, why exactly does any business collapse? It doesn't have enough profit to support its business, and that is exactly what was happening with Silicon Valley Bank and Signature Bank. These two major banks had their money tied up in startups and a lot of assets that were essentially failing because of larger economic problems in our economy today, and also really high interest rates. So they were paying out way more than they were bringing in. That caused a lot of fear and uncertainty with those banks, so there was huge runs on the bank. People went to the bank and pulled out hundreds of billions of dollars all at once, and that meant the bank had even less money to pay its bills, and it essentially collapsed from there. This ended up creating a domino effect for a lot of other banks in the United States, particularly regional banks. We weren't sure if these smaller regional banks were going to suffer a lot of the same problems because they had their money tied up in a lot of the same things, and most of them did not have the money to cover all of their depositors who had money in the bank. A lot of people ended up getting scared and pulled out around $100 billion worth of their money from regional banks all throughout the United States and put them into some of the more larger, more established banks like Chase Bank. But that brings us to this Iowa banking collapse. And like I said before, this is not even the most recent banking collapse that we've seen in the United States. In Kansas earlier in July, there was another banking collapse because of losses that it had on loans. And now the Citizens Bank in Iowa is collapsing because its assets were not able to support its business or the depositors that it had at its bank. So what exactly is going on here? Well, to kind of understand this whole situation, you have to understand how banks essentially make money. Banks make money by you taking your money to the bank and depositing it. The bank doesn't just sit on that money. They don't just let you keep it in a savings account. They then take that money that you put in the savings account and they reinvest it in a variety of other assets, or they loan it out to people who are looking to buy a house or get a car. The problem is in 2023, there are a lot fewer people who are looking to buy a car right now or get a house because of really high interest rates. For instance, in the housing market, the 30-year average fixed mortgage rate is around 8% right now. To put that in perspective for you, around 2 years ago, it was around 2 to 3%. So now people are paying double for their mortgage interest rate, and that is meaning that people are paying a lot more afford just to get a mortgage today. And with really high prices and really low inventory in the housing market, people just aren't buying houses like they used to. So that means banks are not getting that huge amount of revenue like they were getting in 2020 and in 2021. So profits at banks are naturally starting to shrink. And we know this because a lot of the major regional banks and some of the more larger banks are starting to report earnings, and they're noticing that their earnings are starting to shrink, especially when it comes to earnings from interest. For instance, Truist Financial ended up reporting a 31% drop in its revenue due to loss from interest money. Simply put, people are not getting as many mortgages, people are not spending as much on credit cards, so the bank is not getting as much money either. KeyCorp, another regional bank in the United States, reported stable earnings, but at the end of the day, they said that earnings from interest and other things like loans might end up going down in the future because of really high interest rates. Fifth Third is another regional bank in the United States, and it reported better than expected earnings from Wall Street, but it said that its next earnings reports might show drops in its interest revenue because of economic conditions. All right, so that sounded like a broken record, but you get the point here. Banks are losing money right now because Americans are not getting loans anymore. They're not putting their money in the bank. That means that the entire banking sector is getting a lot smaller. And what that is leading to is something called a credit crunch. Banks are making it a lot more difficult for people to get mortgage loans right now and to get auto loans because they have to make sure who they are going to invest their money into are going to be able to pay this money back. So you're going to have much better credit than ever before, and you're going to have to be able to put down more, say, on a mortgage loan than you would be able to, say, in 2020 and in 2021, simply because banks want to bet on you and they want to bet that you're gonna pay that loan back. The reality is many Americans simply aren't going to be able to spend on a credit card, and they're not going to be able to meet these new guidelines set by banks, so they're not going to be able to get a mortgage, and they're not going to be able to get an auto loan, and they're not going to be able to spend money like they used to, which means our entire economy could end up shrinking because of that. That creates a domino effect because now you have a lot less spending going into other things in our economy, like other businesses and discretionary spending like on travel. All of that is going to go down simply because Americans can't spend as much money. One of the other ways the banks make money is by you depositing money into the bank. So like I said before, say you take $100 and put it into a savings account. The bank is then going to turn around and invest this money, but many Americans are not investing or putting their money in deposits simply because they're spending a lot of money in 2023. Inflation last year had a high of around 9.1%. What that means is that things are getting a lot more expensive, and Americans who are not seeing a big pay raise anymore, well, now they're pulling more and more money out of their savings account in order to afford all of the same things that they were buying before. Savings accounts and saving rates are starting to go down in the United States. Many Americans are admitting they either have nothing in savings or very, very little. So that means that banks don't really have a lot of that same money to invest as much as they were before. Not to mention a lot of your investment banks out there, a lot of your banks who are consumer banks, but also do a lot of heavy investing in things like the stock market. Well, Americans are not investing as much with these banks anymore because they're going after higher yield assets like treasury bonds. The 2-year note and the 10-year note are at a near 20-year high, the highest they've been since around 2007. This is because interest rates from the federal government and the Federal Reserve are very, very high right now. So Americans would rather invest their money into US Treasury bonds than with the bank because, simply put, we don't know what's going to happen in the United States with the banking sector because these are all private companies, but we pretty much have a good understanding of what is going to happen with the United States government. More than likely, the United States government is going to be around for at least the next 10 years, right? So investors are putting their money into those assets instead of through bank-sponsored assets, which means even less investing revenue and interest for banks. So let's kind of take a step back here and understand specifically why the Citizens Bank of Iowa eventually shut down. That's going to give us a broader understanding of what that could actually mean for our economy and consumers. The Iowa Bank had a ton of loans tied up in the trucking sector, but a lot of those trucking companies or the companies that were paying the trucking companies, a lot of the companies that they worked for in merchandising are no longer paying. They are starting to shut down. So that's trickling into the trucking sector because now they have a lot less revenue and they're defaulting on their loans. When they default, the bank doesn't get any of its money, money, and that means the bank eventually shuts down. Now, the big takeaway from that is the loans that banks have are really, really important, and the sectors that they're tied up in are very important too. And something that you can do right now is to try to look at what your bank has on its balance sheet. What exactly is your bank investing in? Is it investing in startups? Is it investing in things like the trucking industry? This really matters because these industries could be doing really well in 2023 and into 2024, or they could start suffering, and that means your money could potentially be on the line. A lot of major corporations over the last few years have taken on huge loans in order to grow really quickly, especially when interest rates were very low in the United States. It meant that this money was very easy to come by. However, a lot of these corporate loans come with an adjustable rate. So as the Federal Reserve has raised their interest rates to 20-year highs, that has also meant that now these loans are getting a lot more expensive for businesses to pay off. If they're not bringing in the business because people aren't spending as much, they're going to start defaulting, and that means bankruptcies, and it could mean failures for a lot of banks. At the end of the day, if we put this all in perspective for you, you've got to understand that the United States typically sees on average around 5 banking collapses every single year. Well, right now in 2023, we are at that par. So it's not to say that these banking collapses are anything out of the ordinary, but the sheer scale of them is definitely unusual. Iowa banking collapse is something that the United States is used to seeing, and the FDIC is used to seeing as well, but Silicon Valley Bank and Signature Bank collapses, well, those are massive, and they require the federal government to then step in and eventually come up with a plan that helps pay for all of these issues. Right now, what you can do as an American is, like I said before, look at what your bank is investing in, but also be very careful with how much money you're keeping in the bank. Don't keep every single dime that you have in the bank. You don't want to do this because 1, it loses value every single year to inflation, and 2, only so much of it is covered by the FDIC. If your bank collapses, around $250,000 is going to be paid to you for sure by the federal government. The FDIC kind of pulls from all of the banks in the United States that are a part of it, so you're going to get your money back, but if you have over $250,000 in the bank, well, now you're kind of screwed. So that is very dangerous. But like I said before, you have a choice for which bank you do business with, and you can choose banks that are going to give you the best bang for your buck. And of course, this is not advice at all. You should always do your own due diligence when it comes to investing and putting your money in the bank and just spending money in general, right? I'm just a random person on YouTube, and you should never listen to random people. Always do your own research. But what I'm doing right now is putting my money in a high yield savings account, which allows me to sort of get a little bit more back and beat inflation, but the vast majority of my money is being invested. So that way I can actually earn more than what inflation is, and I can sort of diversify and protect myself when banks collapse or other industries essentially go down. You do have a little bit more control here, which helps you to be a little bit more versatile in this economy. This is not the first time that we're going to see a banking collapse. You have to prepare your money, and you have to prepare for when these things are going to happen in the future. And there's a potential that these things could be a lot more common as the Fed continues to raise its interest rates, keep them high, and the rest of our economy suffers because there's just a lot less spending going on. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.